Welcome back to Live Impact News. And now we're going to talk about your money. That's something that we all adore, right? Our money. Okay, we have with us Tim Fitzwilliams from Fitzwilliams Financial. Of course, he is the man who always has all of the answers to your money concerns. Back with us again this afternoon. Always great to see you. And on a good day, or should I say a bad day, because we do see that the stock market's a little shaky right now, a little shaky. There has just been so much bad economic news, and people are always talking about, the prices, the gas prices, affordability. You say what, though? You say that things are actually not as bad as they might seem to some.
Yeah, I think that you always are going to have outlier effects, right? Mm-hmm. And so the question are those outliers creating a trend? Are you seeing negative across the board and by large amounts? And we're not. We're not seeing that, mm-hmm. right? In fact, we're seeing things kind of starting to actually normalize. For the first time ever, we're having for the first time in a very long time, we're having a productive economy without stimulus and things to force it in such mm-hmm. a way. Mm-hmm. Which is nice. Uh-huh. And the market has recognized the Iran war and has started to absorb that. We were talking earlier about how it's kind of almost ignoring that. Mm-hmm. It's not as spiky as it was. When we were having a conversation a month ago, when something would change, it would directly affect things. Now it's kind of like the markets realize that's what's going to happen. So we still stand on the grounds that as it's starting to be absorbed, it takes time, but as it starts to be absorbed, oil prices will be less and less, and as a result, the gas will go down, and we're not concerned about inflation.
Mm-hmm. Well, oil prices did go up just a little bit, I think, today, and government bond yields remain high, with some concern about renewed inflation. For someone who, just a typical family, if they get like $500 they find in discretionary spending, what should they focus on? What should they be thinking about? I mean, makes you want to run out and buy like a big TV or something like that.
Sure.
But what should you focus on?
Yeah, I think first of all, you want to look at if you have any, what I would call bad debt, right? Debt that's hurting you from an interest rate standpoint.
Yes.
And I would focus on trying to get rid of that first. If you had $500, can I put that into a place that's going to eliminate some of the debt that I may have if mm-hmm. I have debt? If mm-hmm. I don't have debt, well, then that $500 can do whatever you want. You can go to investing. You should have a method or plan in your life laid out on how you budget your monthly income, so you have discretionary money, and I like to talk about it as a fun account and a fixed account. Fixed accounts to pay the bills and to put away for investments, and then of course we have our fun account, which is to just have fun. So maybe that $500 can just go for fun if we're not sitting with bad debt.
Right, you got to get rid of the debt because the interest rates, they can kill you. On
Absolutely.
Yeah, keeping that debt around. You hear people say, "Oh, we're going to have a recession." You say we're not heading towards a recession. I know that last jobs number was not good. It was negative 23,000. That probably raises some concerns. But what are the things? Is it the AI technology? What are some of the things that are keeping us stabilized?
Sure. So, no, we don't believe that we're going to head to a recession. We actually mm-hmm. feel we're at the movement into a growth curve, and that we're moving to a growth part of the economy. Mm-hmm. And so, yes, there can be a report here or there that may be off, but overall, we're still up GDP. We're still doing fine. And if we take out the oil part of the inflation, we're still good from our PCI and our CPI index. So we're still in a good spot, right? We're still in a good spot. And when we look at mortgage rates in the 30-year Treasury, mm-hmm. it's actually back to pre-financial crisis, which is really good. So again, we're in what people may think is not good, but it's more normal. Just that we've had for the last 20 years, some type of incentive or printed money with quantitative easing, or with COVID, creating more incentive programs. We've had all these different incentive programs come along to boost things, which really isn't helpful. Mm-hmm. It doesn't help the economy stay strong. It actually creates a very imbalance. So now we're seeing things kind of more normalized, right? So we don't see that we're going into a recession, not by a long shot. We see that we're going into a growth-based model. In fact, we still hold on the grounds that we might see an increase on interest rates, maybe a quarter point start of next year.
Okay, what are the things that, obviously, ending this war in Iran, what are your concerns? The things that you say, while we're stabilizing now, we really could get to a better point if certain things could change.
Sure. So, like I've always been saying, that as the oil prices come down, gas will come down, but now it's different in today's economy because the U.S. is a large producer of oil for the world, as is the Western Hemisphere.
Right.
So we're pretty much self-sufficient now. So we should see in the midterm, as I've been saying, things take time for it to occur, but we should see gas prices at an all-time low.
Okay, when we see the volatility in the stock market, and let's say you're close to retirement, is there something about your strategy that should change?
That's a great point. I think it depends on what your strategy is and who you're working with. So the biggest question is, are you working with, one, a fiduciary, right? So they have your interest ahead of their own. That's number one. And number two, if something happens today in the market, are they going to do something today? That's called active and tactical management. So if you don't have number two, then you really shouldn't be moving around because it's dangerous. So you want to stay the course if you don't have number two. But that doesn't mean that to stay in the course is the most optimal either. I mean, there's a reason why wealthy people pay Goldman Sachs. And it is not to beat the market on the average return. No one beats the market.
Okay.
It's about losing less to make more.
And it's about having someone there that can kind of find some red flags and say, hey, you might want to do this, or you might want to shift a little here and there.
Well, close. They're not actually saying that, they're doing that. Because in that business model, you're given what's called discretion. That's how we set up our firm as well.
Right.
Where you're given discretion. So people are making the moves while you're doing the news, while you're on vacation, whatever it may be. People are making those moves for you. So if something happens today that could be a negative effect in the market, then movements may occur inside the portfolio today. Hedges may be built, strategies may be done, leverage may be created, right? Things that can offset the loss. Because if you can lose less on the downside, you can make more on the upside without having to take significant amounts of risk. Everyone looks at percentages as, what did my portfolio do last year? What you have to look at is, what was the internal rate of return? What was my dollar on dollar gain?
Okay.
You could have portfolios with widely different percentages. The sequence of return is a crazy math principle that, can produce some pretty wild results. You can have somebody earning 8% as an average return and someone earning 20% average return. Yeah. And the 8% could have more money. Depends on the volatility.
That's a good point.
Depends on the volatility.
Yes.
So when we go back to what you're talking about is, what should you do? You should stay the course if you're not having someone who's trained to be an active and tactical manager, who's acting as a fiduciary for you. And in that, if you do have that, then let them do what they're going to do, because you should have had a conversation about your risk tolerance so they know how to pivot and whatnot. But then they're going to go in and they're going to try to lose less on the downside. And that will ultimately be a better position for you.
Okay. A lot of people that get around 60-ish and they're thinking, they start hearing the R word, retirement, but they don't know when to pull that plug.
Sure.
Like, am I going to do this to 60?
Absolutely.
What is the retirement age now? 65, 67?
It really doesn't. I mean, it's up to you. I mean, so people would say, what is retirement age based on Social Security? And so that hasn't changed. 62 is still a thing, and you can still have full retirement and Social Security and at 67 and then 70 maximum. But I think it's emotional, right? So what we do is we put numbers to that emotion. Okay. So we believe, and then we learn this from you guys. We don't, come up with this preconceived conception of what retirement is in science. I have all these clients and these people that I've interacted over the last 20 years that have told me what they care about. And what I've noticed the most is people say they don't want to run out of money. Well, what does that translate to? That's right. Amen. But what does that translate to on a day-to-day basis?
Yeah.
It translates to having enough income to do what I want to do.
Yeah.
So then what does that mean? That means I'm replacing my income to the level of what I was making while I was working, but now I'm retired. So case in point, if you're making $200,000 a year and you go to retire, I want to continue to make $200,000 a year. How do I do that?
That's hard.
Well, it depends on what you saved up.
Right.
And what you're open to as far as investing goes. Because when you start to take distributions, there's the rule of thumb, 4%. Is that good? Maybe, maybe not. It means that you should make probably 4 or 5% or something like that conservatively in the market will cover your distribution if you're taking out 4, right?
Right.
So then you can infinitely take it out. But normally that's not enough. So you're right. People normally need more. So that's where solutions come into play that might be product oriented, like an annuity, where you can say, hey, I'm going to take this portion of my risk anyway and be in bonds and low risk models. Why don't I use that to give me 6, 7, 8, sometimes 10% distribution rate on my money? And then if I run out of money, it's still going to continue to pay me for the rest of my life. So sometimes people like that model when they're trying to income replace. So going back to the root of your question, how do you know when to retire? The short of it is when I believe, and we stand on the standpoint of when you know you have enough income coming in to do what it is you want to do, which normally means you've replaced the income that you've lost from your previous job. And then you can go out and have fun. And so we try to do that at Fitzwilliams Financial. Our goal is to do that with the bond side of your portfolio.
Okay.
Whether we use dividends or bonds or if we use products like annuities. Whatever fits the consumer and their risk tolerance, right? We're always going to put them first, just like good fiduciaries should.
How do you, let's go to the other end. We're talking about, retirement. How does your firm do some things to try to encourage these young people? I mean, as soon as you get a full-time job, let's say you're 23 years old, we try to talk to our kids about, hey, you got to start thinking about that 401k. You got to think about,
absolutely,
and it's hard to get, that age sometimes to think that way. What are some of the ways that you can convince them that how important this is?
There's some pretty cool stuff that's out now. So really kind of hot off the press, right, is this idea of a self-directed brokerage account. A lot of 401ks and the plan administrators of them, I mean, even local, like Centera, Northrop Grumman, people like that are offering this model. So what does that mean?
Yeah.
It means that inside your 401k, you have selections, right? We all know the different selections. Pick the button that you like, right, based on your risk. Well, there's another button that you may not be able to see unless you go to the HR or whatever and find out how to activate it, but that's called self-directed. I'm going to do it on my own, or I'm going to let somebody else do it. Okay. That's a powerful thing. Yeah. And so there's companies out there, and we represent some of them, and we are one of them, that allows us to jump into someone's 401k. So now you can have an advisor attached to your 401k through this self-directed brokerage account. So if you're young and you're getting started, take your time, because the number one thing that's going to make you money in your life is you. You're your greatest asset.
Yeah.
So don't try to go study the market and do all this extra stuff. Study what you do for your job, become the best at it, and make the most you possibly can.
Yeah.
Get someone else to do. Comparative advantage, right, Jana? Do what you do best, trade for the rest. We always talk about that. So young person starting their job, find an advisor that can help them with a self-directed brokerage account. And if you don't know if your 401k can do that, go ask your HR. Get your plan number. You can call us or call any fiduciary and say, hey, I've got a plan number here. I want to know, can I have somebody manage this for me?
Okay.
And then that could be really nice combination to have a lot more opportunities. Because in a 401k, shopping-wise, you're only going to be working with a certain amount of funds. I kind of liken it to shopping at 7-Eleven for milk or for some type of grocery item you may want. You only have a few choices, right? But if you go to Costco, you got a lot.
And in bulk.
Right, and in bulk. Exactly. So when you select that self-directed option, now you can go out into the free open market and buy in bulk or shop like it's Costco, because it's the total market you have access to.
Interesting.
So that's kind of a life hack to how to have in my opinion, a better strategy toward your 401k. And I think young people should really embrace that, because they should be focusing on being the best that they can be.
Absolutely. Great advice. Self-directed brokerage account.
Yes, ma'am.
Okay. And last question, because I know I'm going off topic, but
no, these are
do
good.
You recommend that people borrow against their 401k? In what cases?
Great question.
You got to make sure
leverage is dangerous, right? Leverage is dangerous as a whole. Margin accounts are dangerous as a whole. I think it's a case-by-case scenario, Janet. Unfortunately, you can't really answer that, here. But what I would say is this: I lean to the side of cautiousness with that. It's a very slippery slope.
Yeah.
It's something that you should definitely sit with a fiduciary with. You should not try to figure it out on your own. Don't GPT it, because GPT can't figure out emotions. And for young people listening, if you don't believe me, ask AI, can they replace a fiduciary? And the answer is no. So you need to talk to a fiduciary who's seen it, understands it, can see your entire profile, all the moving parts, your buying and your spending habits, your budget, and then you can start talking through that process.
Right.
So it could be a very strategic thing. It's the same thing as, should I borrow against my house on a HELOC to do something? To put in a new kitchen? Maybe not. Maybe. It depends, right?
It depends. It depends.
To flip a house?
Right.
Well, that can make a lot more sense.
Right.
Because you're going to get the money back and put it right in. So it just depends on the person and what they're trying to accomplish and what their profile looks like.
And know that if you leave the job, you may be forced to pay up that loan.
Absolutely, because
all at one time.
Yeah,
right?
yeah. You can. It can be forced to pay it up, and that's right. You don't have access to it until it's paid off.
Right. All right. Thank you so much, Tim Fitzwilliams.
You're always welcome. Thank you for
Yes.
having me.
All right, and we're going to see you again at 4:30.
Absolutely.
4:30 on
Can't
13
wait.
News Now. Okay, and we'll be right back.